Okay. Okay, I think it's good now. Okay, yes, so I have experience in finance initially, and I've been investing in multifamily the last 3-4 years. I also do my own analytics metrics, both on market selection as well as property selection criteria. And I've been featured on a few podcast events, including Investa, Best Ever Real Estate Show, etc. I'm the founder of Envy Analytics, which is my data analytics firm, and I also have my real estate investment firm. So that's a little bit about myself. So some ways to reach to this meetup. So please join our channel on YouTube. So you can search for Finance Meets Real Estate on YouTube, and also there is a recent Facebook group as well. So that's that, and you can also add me on LinkedIn and my email address as well. So before we begin today, so today's lecture, today's sort of meeting is a Q&A, mainly a Q&A section on market selection, as I mentioned. But before we begin, we have an expert guest here today. So let me introduce her. So this is Amy Tiemann. So she's the founder of TM1, right? TM1 Asset Management. And she has invested in over 800 units of multifamily. Yes. She's currently sponsoring a deal in Houston, Texas of 180 units. So she knows a little bit about market selection. She will tell us maybe about it. So I'm very curious to hear what she has to say. So yeah. So Amy, go ahead.
Thank you. All right, so I'm going to share my screen. Can I share my screen?
Yeah, absolutely.
All right, okay.
Let me stop mine. Okay, should be good.
All right, so I'm going to walk you through just not the whole deal, but walk you through why I chose Houston. So this is kind of a good meeting because this is my first foray in Houston, even though I'm a Texas investor and I have been invested in 10 multifamily complexes already. I've never invested in Houston. And so I'll kind of talk to you through about why I like the Houston market, what are the things that I was looking at, and then what kind of drove me to invest there. So let's see if I can do this. Come on, work with me. Let me see. Oh, it's just going to let me do this. So let me skip down. This is the SEC presentation, but I don't need to skip through all that. But this is me. So this is my background. I basically was an HR manager in a couple places little places called like IBM and Applied Materials and Philips. And then I turned my attention into, I was a general contractor. After that, I had a general contracting business. It's nationwide. We did retail and multifamily projects in about 16 states as we grew our business. And then I was I became a full-time multifamily investor and manager in 2015. So we were investing in multifamily while we had the general contracting business, but then we just decided to stick it to multifamily, and that was it. So we just did multifamily since 2015. Most of my experience is in C-class reposition plays. That's just, I'm a contractor. I like the ugly, dirty stuff, and I like making it pretty. So that's just kind of what attracts to me. So I'll just skip through all this, but let me talk to you a little bit about, that's all of my apartments I bought. Why I picked Houston. So when you look at a market, or when I look at a market, there's kind of 5 things that you look at, or I look at. First of all is population growth. The second is job growth. The third is in the submarket, the median income, the average median income and how it compares. I also look at crime rates. And I also, because I tend to, my asset class that I look at is workforce housing. So it tends to be families. So I look at school districts. So those are kind of the 5 things that I look at that kind of determine whether my asset will bode well, whether I'm going to be able to reposition it to a higher class or not. So those are the kind of the things. So I started looking at Houston, and it's a fairly large city. Obviously, it's the 4th largest city in the US. It's about to surpass Chicago as the third largest city. And here's why, because basically there's 2,000 people moving to Houston every week. Its population is expected to expand over the next 25 years at a fairly good clip a year. 2.5% annual growth is very nice. You look for on the population growth, if you're looking at a metric, I look at over the last, say, 10 to 15 years, did it grow at a 30% or more, right? So, which is a fairly low number, but because you'll have higher years and less years, but there's so many people moving to Texas comparatively. In the last year, there was a statistic in the last year, there was about 375,000 people that moved to Texas from other parts of the country. And also in Florida, Texas was number one, Florida was number two. So population growth drives multifamily demand, and population grows where there's, job growth. So these are a couple of things that if you look at Houston, all the cool things that are about Houston, and kind of drove where we were at. But these is where they placed number one. Like if you look at all these things where they're ranking, Houston comes out number one in all of these rankings. So, most of our cities, top US destination cities, like 10 years in a row, best race and class. I mean, there's all these different accolades about Houston and how cool it is. 50 best cities to live, those really nice things that they want to say about it. But this is the other thing why I originally had this myth, and I didn't think of Houston this way, but you got to think of economic factors too. So everybody thinks when they think of Houston is they think of oil and gas, right? So if the oil and gas crashes, Houston's going to tank, right? If the oil and gas, the only way Houston does well is if the price per barrel is above 45, right? Otherwise, Houston's not going to do very well. Well, honest truth, like in the last 10 to 15 years, Houston has hated that about itself. And so it's very much diversified its economy. So right now, oil and gas only makes up less than 3% of the economy in Houston. There's a lot of big diversity of employers. And that's another thing that drew me to Houston, was the diversity of the employers, which was really, really, really nice. And so obviously there's more accolades for their work and their work environment. This is the other thing that drew me to Houston, the Texas Medical Center. It is the world's largest medical center. It's in Houston, and it's growing fast, and it's collaborating with universities that are building stuff there. The MD Anderson, which everybody knows MD Anderson, it's a cancer center, is at this medical center. They keep doing, this is TMC 3, just broke ground. That's phase 3 of this medical center, and it's expected to be completed by the end of 2022. So there's a lot going on around this medical center, and it's driving a lot of the growth, and especially in apartments and housing and other things like that in Houston. And these are my properties, and they're about 20 minutes from the medical center. And 20 minutes in Houston is nothing. Just saying. I know, y'all are in New York, so you get it. But a lot of people are in smaller towns in Texas, and they don't understand that. So,
Amy, just a quick question.
Yeah.
So how does, sorry to interrupt, how does Houston compare in its population projection versus other places in Texas?
So the Dallas is the only city that, as far as metro growth, is growing as fast as Houston. So Dallas and Houston are growing really, really fast. Now there's some smaller towns, like percentage wise, that are growing fast around Austin. If you look at the top 10 in population growth, you'll see that probably 3 or 4 will be Texas cities. The United States, like probably 3 or 4 will be Texas cities. So like Georgetown, Texas would be like number 7, but Georgetown's fairly small. It's got like maybe 30,000 people. So you gotta look at the size of it, and then Houston is still growing, even though it's fairly large to begin with. I mean, it's the 4th largest city in the United States. So and if it's growing at 2%, then there's opportunity there. So you got to weigh you can't just look at the growth number, versus you have to look at the overall size of the city too. And then there's gas. So there's a lot of employment stuff happening, but this was the coolest thing that I thought, the coolest thing that I saw. So there's going to be a high-speed bullet train, and they passed a huge hurdle back in September. So this is going to drive, this is a huge economic boom to Texas, but also to Houston. So it drove me to look at the Houston market. So there will be a bullet train that will get you from Houston in step foot in downtown Dallas in less than an hour and a half. And there'll be one stop. And they're building a huge rail station in Houston, and there'll be a huge rail station in Dallas. There'll be one stop near Texas A&M University. And this thing is supposed to just change how Texans get around. You could basically live in Houston, work in Dallas. You could do whatever you want to do. You could, now with COVID, and everybody, like, a lot of people think that this is crazy and like, who cares about transportation because everybody's staying home, right? Because of COVID. Well, in Texas, that's not the case. I can go do anything I want to do. I can go to a restaurant. I can go get my hair done. I can go to a movie. I can do, the state's open. You have to wear a mask and you have to be careful, but you can just basically do whatever it is you want to do. The state's pretty much open. So this coming online next year is going to be very, very beneficial for the state. So we look for major economic indicators like this. Like, this is major. Like, this is going to drive a lot of jobs and a lot of economic growth into the state. Yeah. So that was the reasons. I mean, we talk about COVID and other stuff. We looked at rent growth. I looked at rent growth too, you know, just to kind of see, especially during COVID, what it did. And from July of 2019 to August of 2020, so right during the middle of COVID, I mean, we were pretty much open. In Texas, we were open in May. The governor took a bold risk and opened up the state. So back in May, everybody's been able to pretty much do whatever they wanted to do. Doesn't mean they were all working, but you pretty much were able to go to a restaurant. I mean, lots of people gotten back to work. But the rent growth in Houston was 4.3%, which is amazing during a pandemic. So that was another thing I looked at too. So that's just so I was looking at job growth. I was looking at major, a major economic shift that might be happening. I looked at the economy and the economic growth, and I looked at the population growth, and those were the kind of things that led me to invest in Houston. I already invest in Texas, so I'm sold on it. I'm from Texas, like, no big deal. The landlord laws are friendly. There's lots of reasons why I stick to my home state, but this is what drew me to Houston. So, and I had never invested in Houston before, so FYI. So that's me.
Good. So what's your deal currently? Like, what is the deal that you're currently sponsoring?
So it's 180 units that we will build, also an additional 30 units. There's an acre of land that comes with one of the properties. It's 3 properties, they're smaller. But it's 180 units that will eventually be 210. And I'm buying them at $54,000 a door. So, which is, even in Texas, that's a great deal. Just saying. I mean, it's a great deal. The CapEx budget is about 2.5 million because it's a reposition play, like all the other stuff I did. And so we'll pretty them up. They're ugly. We'll pretty them up. We'll change the tenant base. We'll change the cap rate because we'll get into a different class. And so my IRR is like 31% over a 5-year hold. Oh, wow. That's my IRR. Yep. So that's my deal.
How can people reach to you if they're interested?
The easiest way to get me is, the easiest thing for people to remember about me is just go to investingwithamy.com. And I can tell you my TM1, whatever, but nobody remembers it. So just investingwithamy.com. They go there, they'll get to my website, and they'll get to look at the deal. And then my website will have more about me and how to contact me and all that kind of stuff. So, yep.
And yeah, we have a couple of questions. So it's a 506C, right?
Yes, it's a 506C. Yes.
How did you find the deal? Another question.
How did I find the deal? Well, because I've been doing this for so long, a broker threw it my way. So it was, I had made an offer on another deal in College Station, and the owner backed out, and he said, "Oh, well, I happen to have these 180 units. You want to take a look at them?" And I was like, "Well, I have never been in the Houston market, so let me look at that and get through all of that." And then I looked at it and went, "Yeah, totally." So that's how I got the deal, through broker relationships. So, yeah.
In your other deals there, in which cities you mentioned?
My other deals were in Austin,
Yeah.
Bryan College Station,
Mhm.
and Corpus Christi, Texas. So they're all in Texas.
Awesome. Awesome. Thanks, Amy. Thanks a lot.
Okay, thanks. All right, I'll stop sharing now.
I have so I have one more feature here today. So Mark, are you on?
I am here. Yep.
Yeah, cool. Yeah. Okay. So yeah. So Mark is a syndicator as well, actually, and he's my friend here in New Jersey. So he has like a very interesting article that he published on his website. So his website is investwithmaple.com. So he's the founder of Maple Capital Partners. So he wrote an article about like 30 resources, sort of when we're researching a market, I believe, right, Mark? If you want
Yeah,
to
that's exactly right. Here, I'll post it in the chat
right.
there.
Yeah, and feel free if you want to share your screen or just talk about it, however you prefer.
Absolutely. Yeah. Amy, I'm going to probably dovetail off of a lot of the aspects that you mentioned there. That was great. So a lot of the things that I look at when evaluating deals and, even looking at LP deals, because frankly, even if you're planning on passively investing, one of the things you want to do besides looking at the sponsor and evaluating their credibility and looking at the deal and perhaps doing an underwriting there is really look at the market that they're investing in and why they believe in it. Amy did a great job of kind of elaborating on some of the things that she's seeing in Houston. And I would just urge you all to kind of do your own research as well on some of the markets that maybe you want to be investing in. It's no real surprise to a lot of us probably in the real estate world, what's going on now, the great migration that's happening, predominantly from areas like the Northeast and coastal markets like California into more affordable markets, predominantly in the South and Mountain West. So when she mentioned investing in Texas, I totally get it. Some of the factors that I look at, frankly, are well supported, or I should say, are supported by a lot of the cities in Texas. One of the most important things that I look at when evaluating a market is really the politics of the area. Now, not to get too political, but some areas are better to invest from a business standpoint than other areas. And that should be obvious, fairly obvious to a lot of us from a tax standpoint and just from a pro-business standpoint. Obviously, you want to put your capital to use where it's, where it's appreciated. So that's a lot of the explains a lot of the interest that you're seeing around the Southeast and some of the areas in the Mountain West there. So as I mentioned, the politics in the particular area, also some of the factors that Amy mentioned as far as population migration. I also do a little bit of digging, I guess, to the next layer in terms of migration, and I look at what is that migration composed of? Is it retirees perhaps going there? Is it millennials? Say our 18 to 35 demographic. And why I look at those, the composure of the people that are moving, is really it's going to tell me what their goal is. Are they going to be renters? Are they going to be buyers? What you want ideally is a supply demand imbalance. You want a lot of people moving somewhere where they're not building quite enough units. And I think a lot of the markets that Amy touched upon in Texas exhibit those signs. The next thing that I look at is really diversity of employers. So in addition to job growth in these markets, you want to look at what sectors are those that are hiring. You definitely don't want a one horse town, as they say, Detroit in the 1990s or even in the 2000s, leading up to the Great Recession, when you had so many, such a reliance on the automobile sector, and then when that fell out, really the city of Detroit really struggled and eventually went bankrupt. So you want to look at your diversity of employment. I look at as a metric. Usually, I don't want a particular industry to represent more than 20% of that particular city's employment. So if it's something like manufacturing, I might take a second look at it. Or another popular one is you might see some military-based towns. Now, some people might have some other feelings about that, but me particularly, I'm not one to make a bet based on decisions that are made in Washington, ultimately, that are going to impact the market that I invest in. So if it's a market that's heavily reliant on a military base, I will tend to steer clear of that. besides that, I also look at wage growth. You know, where are wages going up? Because ultimately wage growth is going to drive rental prices and rental rates. So, you know, you want, in addition, tons of jobs, but you want high paying jobs as well. So that kind of goes to my original point of not just looking at where are jobs going, but what are those jobs composed of? Also, I mean, besides looking at all of these cities and pro-business states, you also want to be super focused on the submarket that you're investing in. You know, real estate is hyper localized. So it's not enough just to know that you're in a great state or a great city, but are you investing in the right places? And when I say the right submarket, I really mean the right neighborhoods, basically. The places that are kind of on the path of progress, as they'll say. And for that, you know, I've included some resources here, but I would say your best resource in terms of a lot of these questions is really your team members. So when you go and you're looking to invest out of state, one of the first things you want to do, obviously, is build your team of trusted professionals, brokers, property managers, even some case regional lenders. And those are the people you really want to lean on for some of this data and some of the information beyond the data. So we tend to, if we're looking at a new market, we tend to build those relationships first and visit the market and really see on the ground where is progress happening, where are new developments going up, where are the roads, you know, being improved, and those things like that. The development in these particular markets will tell us where we want to be next. Those are kind of some of the things that I've included in there, but I'm happy to answer anybody's questions.
What's your target market right now?
Nashville, Tennessee.
Nashville.
And yeah, it's another zero income tax state, Tennessee, just like Texas.
Sounds good. Cool. Awesome. Thanks, Mark. Really appreciate it.
Absolutely.
So if I may ask you guys to actually, if you want to just put in your market that you want to invest in on the chat, so that would be helpful, and we can have a bigger discussion. I'm really curious as to what areas everyone is investing in. Okay, we have New York State. Yeah. Okay, so you can continue doing that, and I wanted to give actually a little bit of perspective from my standpoint. Yeah, Mark, I think you're not sharing your screen, right? No, you're not. Okay, that should be fine. If you can maybe turn off your camera for a second, if that's okay. Yeah, thanks. I'm not sure. Maybe it's just on my end. Okay. Yeah. Okay. Sure. So, okay, I wanted to add like something to like what our like expert guests said today. So I think those are like very good criteria. Usually, like when we look at population, income, and so specific development, such as like having a high-speed train in your area and things like that. But I feel like I want to add something to that, because I did a lecture back in August, and some of you saw me back then, I believe, where I argued for using valuation metrics in real estate. So that's an additional thing. So valuation metrics being equivalently, sort of comparatively to finance. I feel it's really underused. I think it's not, almost nobody does it. It seems it's not particularly common. I mean, there are economists who write about it, etc. But I mean, as you know, in finance, you have price earnings ratios, and when you're investing in a certain security or in an industry, etc., you want to make sure that it's not overvalued at the current time. I think in real estate, obviously, that one can do that by price to income or price to rent, etc. But I feel it's not specifically utilized. I don't see it like too much. So that's one thing I did like back in August. I argued for using valuation metrics. So that's one thing. Additionally, now when selecting markets, if you look at, for example, purely what price performance has been. Now, do you know that price performance is real? Now, what are your time points? Now, what is the starting time point and the ending time point? It's not obvious. I personally don't know that, right? So you have to have a valuation measure to even purely know performance. You have to start at a fair valuation time point, and you have to make sure that you're ending that the current time is not overvalued as well. And that's one thing to look at when knowing price performance. Now, if you want to know the volatility in a given market, and again, I'm speaking purely as a finance person, you want to know the volatility in a given market, do you know the volatility in that market? If it was due to noise and due to sort of like overvaluation? Not necessarily. You need to normalize by income, and ideally by more than that, like population, housing supply, etc. Normalize by that, and only then you would have a sort of more accurate measure of volatility that you can that will be your true risk, so to say. Because I did like a study. I tried to look at what are risk-adjusted returns, right? I mean, that's an interesting question. If you take different states, now some states, if we take Florida, right? Florida has had an outstanding performance, but it has been super crazy volatile as well, right? Well, but volatile, not adjusted for, not in valuation terms. And so is it better? Is it, I mean, it's not entirely obvious, right? So there is this thing that even purely, if you want to adjust, if you want to look at your risk return framework, how can you do that? You don't know if there is too much noise in the, in the price side. You don't know if the volatility is basically, it ends up meaningless. So I tried like doing, and I shared back then some metrics on risk-adjusted return and showed, okay, that's not even doable in the US. That doesn't work. And so that's another thing. And if you take price performance, if you have Florida, again, it's a perfect example. So if you take Florida from the peak in 2007, and that's one of the best performing markets. Where is Florida right now? Florida is slightly below the peak. So is that a strong performing market? It's an outstandingly performing market. Why is it slightly below the peak? Well, it was super, super heavily overvalued at the peak in 2007. So you wouldn't even know the price performance, or I didn't, for Florida before having a history of valuations, where evaluation is, okay, the normalized prices at every time point. So once you have those normalized prices at every time point, you sort of know, okay, now this is the time when it reached fair valuation. It's at 100, let's say. And that's something to consider. So then you know, okay, that is starting at that point, which in Florida may have been 2010, I believe. Starting at that point, okay, now that's the actual appreciation, which has been super, super high. Another thing I look at, and again, I am purely speaking, again, it's purely as a finance person, not the genuine, like, like different investors, they know their market really well. But if you know your market really well in its sort of physical aspects, do you know it really well in data terms? Not always. Like, for example, like some of these things that I'm mentioning now. So another thing to look at is, so where real estate is very trend driven. So in real estate, there is lots of momentum. So that's not so in every single other market. But real estate is very trend driven. So what happens is, in real estate, if you have high performance last year, you tend to get high performance this year as well. Now, at the moment when the peak in cycle gets reached, obviously that no longer holds, and it's done, right? But there is really strong momentum in real estate, but that's differently strong in different areas. I believe there was, and I was showing like some data back then, and I believe there was Alaska. And I'm not going to be going into too many details here, because that's just, we want to like see what different people have to say, and it's more like Q&A, like open format discussion. But I believe Alaska had sort of negative autocorrelation, so it's like negative momentum. So if you have good performance before, it's kind of the opposite. But that is a huge exception. That's not common. What is the more common case is that you actually get the same performance or comparative performance next year. The strongest case for this is actually is Massachusetts is number one, and then second is Florida. So that's another thing. If you invest, I think autocorrelation in one of these two is like 79%. So if you invest there, if you want to make a best bet, where is going to be the best appreciation in the next 3 years? Now, would I look at purely population for that? Maybe no. Because population, if you try to project by population price performance, it doesn't do it. You have to add income as well, and that's why like our presenters, they mentioned, like, for example, job growth and job diversity and all that. It's a very important factor. It's not only population. If you take population and try to correlate this to prices, it's like 40% correlation. That's only, even though we know that all those booming markets, and it's true, like Texas and Florida, and pretty much the whole western half of the US. The whole western half is like booming heavily, and a little bit to the south, right? But almost nothing in the eastern half. And there is Tennessee, indeed, like where Mark is investing. There's Tennessee has decent metrics, but the only really super booming on a state level market in the whole eastern half is only Florida. So but again, if you look at, again, purely taking population, is it going to be that you'll be able to predict prices? No, it's not enough, because there's income. That's part of the reason why the Northeast, which is incredibly crazy weak, and it's like one of the weakest areas in population terms, has actually sort of held, because there has been more income growth. There's sort of a quality aspect to it. If you have people, foreigners coming from abroad who are professionals, or et cetera, maybe they're sort of raising the area a little bit. But again, it's still, for the most part, population is a huge driver, but just something to consider. So yeah, so those are like some comments. So one is, look at valuation metrics as a risk management thing. That is my main preaching. I constantly do this everywhere. I've spoken about this at a few events. The reason is, it's not going to matter until the peak. But once the peak is reached, that's going to correlate the highest with the subsequent drop. So that's what happened in 2007. So in 2007, the states that were overvalued, which were California, Arizona, Nevada, Florida, were the most overvalued, like 40–50%. Their drop in prices was sort of 40–50%. And then states that were undervalued, they almost didn't drop. So that is one thing. And the correlation between sort of the vector of how much markets were overvalued and then how much they dropped subsequently was 83–84%, depending on which data one uses. So that's what happens. So that's one thing. It's a risk management measure. It doesn't matter though before this. It doesn't matter at all, because before this, it's going to be driven by the second thing of the measure. So first thing, again, like besides the things you guys mentioned, I'm just like adding my own like kind of 2 cents. Like first thing, valuation. Second thing to look at, autocorrelation. Autocorrelation is momentum, sort of the price time series, t-1 versus t time 0 versus t-1. And that's it, autocorrelation, and yeah, what was the third one? I already forget. So that's about it. And yeah, so I was curious like what markets you guys have. So we're starting with, so the first market we have today is New York State. So why? So that's, I'm not sure if so. It's first name is Jamil, I believe. So why is that your choice? I was just curious if you wanna speak up, or you can put it on the chat as well. I actually do invest in New York State for certain reasons, even though it's weak demographically, for my own views. Do you want to share with us, Jamil? Yeah. Okay. Okay. So let me. Yeah. So I'm going to give my 2 cents on New York State. So New York State is very interesting. Okay. So again, my perspective. So that's, I think, is it number one? Maybe like our speakers today can say better. Is it number one for like the worst domestic outflow of population, or it's number 2 or something? I think it had like 7% outflow the last decade, or
I think it's number 1.
Yeah. So it's like very big. It's very big for sure. Okay. But one thing that this brings though, and why I invest actually for some of my small deals, sometimes in upstate. And right now I have 2 actually myself. So what that brings is massive illiquidity. So yeah, so you're going to be screwed. You're not going to be, I'm not suggesting one should do that. That's more like playing with fire, Okay, so the right thing to do is invest like Amy in Texas, in Houston, Texas, and all those booming markets. So that's the right thing to do. Now, if you want to be a little bit, take a higher risk, you could do sort of maybe flips or things in illiquid markets. And part of the reason is like some of the things I've been seeing upstate. If you pull a lot of data on it, you get to see like stuff that is selling at 50% of its tax market value. Now, the tax market value is not an accurate measure, maybe, but it's not super off. Most things, even in that super shitty market sort of, even there, most things trade close to their tax market value actually. But there are some that don't, and if they're like 25 or like 50% below, I mean, I think that's an opportunity, because even if you, what's going to happen is you will not be able to sell it easily, etc. It's difficult, but you still have it. Kind of, you can use it. You can take out cash, from the deal instantly. I'm referring to actually almost turnkey deals, almost turnkey that are trading well below. So that also happens. So that's one thing I just want to say. And purely like the parallel for this in finance is, okay, well, if you have cryptocurrencies, for example, right? You have cryptocurrencies and they were less and less liquid a few years ago. And now they are more liquid, but they're not liquid enough. And if you look at, I used to do this before, like sort of trading between exchanges like cryptocurrencies, right? And it's doable. That's actually very profitable. And there are people who say it can't be done, but it's not true. And then, but when the reason why that's the case is illiquidity. So that's like the purely, so that's another thing. Like I think markets like New York State, they definitely work for that. And they're also very high cap rates, but it's tricky because it's going to be zero appreciation there. It's that's one of my things I kind of think about now. So yeah. So then the next market we have is what do we have? Well, Westchester County, New York. I mean, that's sort of similar, but close to New York City. So Westchester County has performed well, a little bit stronger. I think in New York State, like the strong performance has been, of course, New York City, but only New York City and a little bit its suburbs, and then very far up by Niagara Falls and Buffalo, in fact. So Westchester County has got sort of average performance. It's okay. I mean, there is good income growth there, I believe. So it has been okay. But overall, I mean, it's very precarious investing in New York City or close to New York City right now, I personally believe. And
Stefan,
yeah.
can I interject on one thing on the state of New York? One thing to keep in mind too, and I always look at composition, all of these things, I'm trying to dig one layer deeper than just population growth or just wage growth.
Right.
Looking at the state of New York, they've had net domestic outmigration for the last few years, prior to COVID even. And what that means is Americans moving more out of New York than the state takes in every year. And how is that possible without the population, severely being hampered or severely falling? It's really the only reason that the state of New York's population is staying stagnant is really internationals coming to the state of New York.
Yep.
And you have to ask yourself, in some respects, that's good for a landlord because those immigrants tend to be renters. But in some respects, it's bad because, as you said, illiquidity. You have to always think about when you're investing, who's going to buy this thing when I'm done with it? Whatever your hold period is, 5 years, 10 years, who's going to be the marginal buyer who's going to pay up for this thing? And in the case of New York, it's a little bit more tenuous to say, a little bit harder to say.
Right. Well, yeah, that would be more like illiquidity, more like further out of New York, further from New York City. But you're absolutely right. You're absolutely right, actually, for that. And yeah, I mean, I think it's I would not invest anymore close to New York City in that sense, in terms of like expensive deals and etc. I mean, what happened in New York City actually, like when people speak about, for example, the 70s and like there's, it was really bad in the 70s. Yeah, but then, right? I mean, let me know if you guys agree, because I mean, I'm from here, but New York City was super booming before that, had huge population growth. It's not like I'm sure it wasn't bad before the 70s. It became bad in the 70s because there was a huge outflow then. And I think it seems that there was like 10% outflow of population. So if we don't say it now, it's speculative. I cannot say anything for New York City. It's totally speculative. But if we start seeing in the data some population outflow, and if at some point, that becomes like, 10% or something, then it's going to probably get a little bit sketchy, because that's what happens to all cities, especially like in Northeastern America. I mean, a lot of them are actually sketchy. And then people are moving to suburbs, etc., because that's what happens. They're kind of leveraged. It seems to be a financing question. It's somehow financing in US cities look different than Europe. So they tend to get like super ghetto, if a little bit of tax outflow, and they start becoming ghetto. It's quite interesting. So yeah, so New York City, I personally wouldn't touch it. So North Carolina is an interesting one. Scarlett Herbert. So do you want to share with us where you're investing there?
Yeah, so I live in North Carolina.
Okay, yeah.
I'm stationed here at Fort Bragg. I'm in the Army. We have a single family home, but it has kind of like a guest house in the back. So we live in the smaller, it's like just like a 1 bedroom kind of deal. We live in the back house and we actually rent out the front house. We rent out each room instead of
Mm.
instead of doing the whole house. So each person that lives in there is just like a military person trying to get out of the barracks.
Okay. So it's more of you actually live there, so that's your proximity. Real estate is a physical asset, obviously. So you kind of that's where you invest. It's not so much a case of you rationally decided that's the state they want to pick, even though it's not convenient for me or something like that.
Oh yeah, no, but the market here is amazing. Single family homes are super cheap. If you can find all the like the quadplexes and triplexes are
Which
they're
city?
usually
Which
take.
area you said?
What was that?
Which city or which area?
I'm in Fayetteville, near Fort Bragg,
Okay.
the military base here.
Mhm.
But Raleigh and Durham is also really popping right now. It's a big city over there, like an hour away from here, and it's super nice.
Yeah. Okay, that's cool. That's cool. Yeah. One thing I want to add actually about North Carolina, and I don't know the market there, obviously, but one thing just purely in the data. So like North and South Carolina, people speak of them as sort of like booming markets. I don't think that's yet the case. They seem to be booming in specific cities. They're not booming on a broad base. There is no market in the eastern half, like you said, of US that is actually booming on a broad base other than specific cities. That's only Florida. It's like in North Carolina, if you look at the rest of the markets that are not Durham or Raleigh and like a few markets there, they're actually performing like Northeast. They're like New York State in appreciation, which is quite interesting. So it's not like if you invest there, you're going to have a huge success. Yeah, if you invest in the right markets, you will. On the contrary, if you invested in Florida, just try hitting a weak county or something, like almost all of them are booming. So that's just something I wanted to add, like, just like my perspective, what I have seen. I don't know if you guys agree. And yeah, so next we have South Florida. So Gerard Aliberti, do you want to share where you're investing in South Florida? Okay, I guess maybe we said enough. And yeah, or Nicole, actually. Nicole, do you want to speak about Florida as well?
So for me, it's not so much for buy and hold or multifamilies. It was more for the Orlando area for short-term rentals, which I haven't gone into yet. So I'm still working on my market research in that area. I have buy and hold in Union City, New Jersey, which I believe you've also invested
I
in.
do, yeah. That's an interesting market, actually.
It is. It's very odd what, this area is very, very odd. But yeah, there's definitely some strategies that still work in this area if you can deal with the building department and all of that fun.
Right. Yeah. I mean, still, I would say, yeah, at least for me, it has done well in terms of the sort of mix of appreciation and cap rates, and like being, yeah, one could, if you can, yeah, if you also take a risk and break the rules of the town and do Airbnb, it's like 20 minutes from the city. That's also a strategy that some people do. So. Yeah.
Well, actually, in this area, I wouldn't suggest it. Not in Union City.
No, yeah. No, I agree.
Yeah, because Union City, they have eyes and ears everywhere.
Yep. No, I agree. I mean, yeah, I've seen some people have bigger success with that than others. But
I wonder if they know in the city.
yeah. So Florida, like where in Florida actually you said?
Orlando is what I'm looking for for
Yeah.
short-term
Yeah,
rentals.
great.
So
That's
yeah,
great.
yeah. Any insight onto that? Because I'm just beginning my market research in that area for short-term rentals. So any insight anyone has would be appreciated.
Yeah, I mean, I don't know, again, I don't know. It's just my personal opinion again about Florida. I said there's such high momentum there. So it's overvalued. Florida is overvalued currently. I think it's like 11% overvalued the state, because that's what happens in strong markets. You know, there's then a lot of competition, and it's overvalued. That's what I see. But that's not so bad. That doesn't mean it's where the price growth is going to be the strongest in the next year. So yeah, I am thinking myself to should force myself out of my comfort zone and start investing there more, because it's yeah, you know, it's very, very amazing appreciation. But you just have to be careful. My only thing, in my opinion, you just have to be careful to kind of exit at some point.
Yeah.
If it becomes more overvalued, because now it's like 11% over there, that's okay. That was the same like before 2007, like in 2004, let's say, maybe it was the same. But then, you know, really quickly over several years, it can get like super overvalued sometimes. Now that was a big exception then. Maybe it's never going to happen. It can also stop being overvalued. But it's something to consider, you know, that you can see like some downturn in prices at some point potentially in this sense. But until then, it's going to be the best place. So it's definitely the best market in the Eastern US.
So I'm curious how you know, how do you determine the percentage of what an area is overvalued?
Yeah, I spoke about this before. I'm not sure if you saw me like on my lecture in August. So you can check on YouTube. So
Okay.
like the channel is Finance Meets Real Estate on YouTube. The check and the video is called US Real Estate Valuations and Outlook.
Okay.
Post 2020 recession or something like that. So US Real Estate Valuation and Outlook. And that's, I don't know, that's at least, I didn't know. I mean, others may have other opinions. That's just something I do. So what I did there was really sort of simple. So at that lecture, I did price, you pull up like histories of prices and incomes from just like governmental agencies. And I just looked at deviation from historical price income ratio. But the whole work is you have to see, like, pick a good period for that, like a good historical period, like what works best, what is most predictive. And yeah, so that's what I did. So it's just like deviation of historical price income. That can be improved because this works really well at the state level, but it's a little bit less good at the county level. And it's really difficult at the county level to predict stuff. But if so I've been working on an enhanced kind of metric that has like population and has housing supply in there. But this is the general principle: is you just want to have prices. You have prices, but you don't want to look and just price. You want to normalize them by all the input components. So you want to normalize by income, normalize by population, housing supply. If you can normalize by anything, ideally, and then that's going to be like, and then try to test it and kind of calibrate and see, is this metric, how it performs? Is it predictive? Was it able to predict the 2007 crash? So that's what I did there. And that's like the only reason why I'm using this now. And I'm using, 11% for Florida. The only reason is because the exact same metric worked for 2007, predicted the drops then. Now, maybe it's going to be different now. But also there can be no drops. But again, this is what predicts if the peak of cycle gets reached. So that's it. But I mean, 11% is just, it's very normal. It's like fairly okay. It's just most markets are not overvalued, FYI. So those are just very, very few. They're like 8, I think, out of 50 states. The US real estate currently is super fairly valued. There is only 8 states that are overvalued. And that's what I see only. And Idaho is the only one strongly overvalued. It's like 23% or something. And then if you take Boise, Idaho is like 33%, and people are still investing there.
Yeah.
So that's already, in my opinion, I would not touch it. Even though, yeah, that market will be very, very strong. Even if it's a 33% overvalued, it will still continue strong because there is momentum again. The overvalued markets, they perform strong until they hit the peak and then they go down. So but yeah, they are willing. But all these other ones, I mean, now Florida and Texas, they're the best markets. I mean, everyone, those are the biggest markets for multifamily. Those are where everybody's going.
I had a question.
Yeah, I mean.
So if you, the Wharton professor, his name is Linneman, and he was talking about asset-based inflation. So for the next 5 to 7 years, he predicts that there will be asset-based inflation, which will be very, very good for people who own multifamily, right? Because it's one of the best assets to own. But in those those markets that are already overvalued. So, I mean, you drive your value of any sort of multifamily, it's based off the rents you can get, right? And what your NOI is. And that's how you determine what your value of your process is going to be. At some point, the rents can't go any higher. Like at some point, the median income you cap, right? So is there anything other than, trying to do that all on your own, trying to figure out what the delta is between what the median income is and where the rents are and what room is there to grow? And that was kind of what I was going to try and do. But like I have time.
Amy, that's one of the things actually that I try to look at as well. I didn't mention that before, but affordability is huge. You've got a pretty good portion of the population that's been shut out of the job market now. And frankly, their wages haven't gone up in the last 20 years. So those people, as much as we want to go in and, increase rents and, make a good return, it's like there's only so much that these people can pay. And I know as, a residential landlord, I usually look at when I do my vetting for tenants and stuff, I'll look at, what is their income compared to the rent. And I'll try to see some kind of delta there. I try to say generally 3 times I want in gross income versus rent. And I try to apply the same thing to markets too, to see, okay, how much room is the upside, and not that you necessarily want to overcharge someone, but your plan is to go in. If your plan is to go in and like Amy, like you mentioned, you're a value add. It sounds like you're a value add investor and you try to go in and make some positive changes to the asset and ultimately increase rents. Hopefully there are tenants that are willing to pay that, but they also have an upper limit. And it's assessing where is that limit. For me, I try to look at, okay.
Yeah,
is it at what point does it become too much of their wallet share?
Okay, but I actually want to speak to that. That's actually a very good, very interesting point. But how do you know what's the upper limit? Now, if you look at the cities, the big cities, okay, you have like cities with, so you have, we have certain markets where like the price to income is maybe 5. Okay, and then you have like these cities where price to income is probably 20. So is that above an upper limit? Like, how are people living there, right? Okay, they're super squeezed, and yet they want to be there because they like other people, I suppose. They want to be where other people are, So, but they're super squeezed. Their affordability is at 20. It's not at 5. And yet, let me tell you what I just want to make a comment on this. A market where affordability is at 20 by itself is not overvalued. That's just what I want to say. That's why, like when I was saying, like on price to income rate, that's not going to predict anything to you in terms of if you want to see a drop afterwards. What's going to predict is if this affordability changes. So if you have San Francisco, and San Francisco is super, and that's, I spoke it actually before, like, and San Francisco is like not affordable, right? The fact that it's not affordable and the people are super squeezed and they're super poor in San Francisco on relative basis doesn't make it overvalued. It's going to be overvalued if this affordability changes above a historical level. And only then you can, I'm not like making this up. I'm just speaking purely from the perspective of what's going to predict your drop afterwards. That's what I see. So it's changes in affordability. So that's like another, but that's still a good point. Now, absolute affordability has to matter in some sense. Maybe there's just higher risk there. Okay, for example, now when you see like a shift, such as with COVID, you have like, remote work. Okay, so then that's gonna be reflected. So maybe you have a higher risk in those areas in some sense, but purely on its own, I just want to say a market not being affordable does not make it overvalued. It can stay not affordable. It can get much more not affordable. More not affordable to an extent. And that's just what we're seeing. That's what happens in those cities. And another thing is that if it became more not affordable due to sort of housing shortage, that's what happens again in cities, right? So if it becomes due to population and housing supply, so there isn't enough housing supply for the population, that's not going to be overvalued. That's going to be reflective of that there is housing shortage, but it's not overvalued. That's another thing I think. So that's why let's say when I was working, at least for me, and let me know, like European, I was working trying to guess for like counties, like the small geographies, which places are overvalued. So I wanted to add the housing shortage in there, because what happens is like you have like all these markets that they become like super not affordable, like in the more and more over time, but they're not necessarily overvalued. They feel like I'm overestimating their valuation, you understand? And I need to like, okay, put housing shortage, and then once it's adjusted for housing shortage, then already you see it. So I know something, just some comment, because like people speak about affordability a lot. And if you always see if it implies, okay, it's just the absolute affordability, and I agree, it's a risk in a sense, but it's not what drives drops. It's not what drove like 2007 crashes. It's not that California dropped because it was not affordable. California dropped because it was much more not affordable than it was on some historical basis. And so that's just something I just wanted to say like on that. And then, okay, so because we are like really advancing with time, but thanks, Mark, actually, that's a very good comment. And then we have, Konstantin, my friend, he has Toledo, Ohio, Newton, and West Frankfurt. So do you wanna share why you invest there?
Yeah, sure. So for me, it's always been, I mean, I pretty much select properties that are very, very affordable. And I kind of chase markets where not so popular and see if I can turn positive cash flow from those assets. And eventually, it's, for example, Toledo property, I purchased a few properties and I purchased land as well. But it just turned around. The market I purchased in 2017, and Toledo Ohio has been going up and up and up. It's probably up by 22 or 24% since I purchased. It's just pure luck and like an accident in my case. So my main priority is chasing a low price and looking at the cash flow and not thinking about whether I'm going to be able to sell the property later. But I'm not talking about multifamily. I'm just talking about under 4 units, single family duplexes, and I'm not talking about 60 units apartment complex.
But I think
also
because just to share, like Konstantin and I, we know each other really well. So he's like a very big auction expert, kind of. So he's got like really successful deals on auctions. And so you're mentioning cash flow, but you always buy stuff that is super undervalued. So there's a lot of illiquidity and inefficiency there. So that's I think that's the reason why you end up in these markets, which are, in price terms, either your estimate in Toledo, Ohio is wrong, or something. The zero estimate maybe is wrong. I don't know what's happening, but Toledo, Ohio otherwise hasn't grown, or just your specific neighborhood maybe grew. But Toledo, Ohio is not like a booming. I mean, there has been some growth. It's decent. It's okay, but in this sense, but it's more like markets that you can find stuff that is trading at a percentage of what should be the market value, and like try to capitalize on that. That's, I mean, let me know if you agree.
If you like, I was just looking at LoopNet the other day. You can purchase something like 20 or 30,000 square feet office space for like $100,000 right now in Toledo, Ohio. Just take a look just for fun. It's just unbelievable. How is that possible? I mean, I'm sure you're not going to make money there, but it's so strange.
Yeah, or like land with a few $100, etc. It's crazy there. It's so cheap. But yeah. Okay. Then we have New Jersey. So yeah, New Jersey, I have invested quite a bit in New Jersey, so I can say about that. I mean, yeah, it's New Jersey, Hudson County, New Jersey has done very well in appreciation terms. So that's one example again in Northeast. If one thinks in Northeast, so you're screwed. Well, maybe you will be in the future, but retrospectively, it wasn't the case. In Hudson County, New Jersey, one could have really good appreciation. So that performed like the way Raleigh in North Carolina performed, or these kind of markets. So the price performance was strong. Now, are there cap rates there? No. I mean, the average cap rate is 4. Now, at least what I see now, but are there cap rates at the extreme? And if you look at like the investment in small multifamily, let's say like 4 units and etc., you can get 9 maybe. So that's kind of okay, and appreciation is good. So that can work out. New Jersey was overvalued in the previous cycle in 2007, and it's undervalued now. As it's much of Northeast, so the plus side in prices are not going to drop for you if you invest there. I can bet personally, because undervalued markets, they don't really drop much. Now the only thing is, now if you have like specific small geographies, if population heavily moves out of there, which is definitely a risk at this current time, so that can be. And then Buffalo, New York, and Northern VA. So Buffalo, New York was actually a booming market. Really, it's interesting enough. I think it was like 40-50% above its previous like fair valuation in 2010, which is, I don't know why, I have no idea. So do you want to share, like Kaja? Is it Kaja?
Yeah, it's Kaya.
Okay, sorry.
No, I mean, it was honestly convenient. So I live in Northern Virginia, which is not conducive to buy and hold at all. So we have property there, but realized not good for cash flow, which is really the goal for us. So we've got family in Buffalo, so it just made sense. The numbers made sense there, and even though we weren't not thrilled about the state, but it's just a place that we knew we were going to be and could build a team and have family there and such. So
right, yeah, for some reason it did really well. I don't know if maybe it's going to reverse afterwards, or given how weak the state is, but for some reason the city kind of boomed.
Yeah, and it's really great for like burring and just finding good deals off the MLS. Like you can still do that there. So
yeah, right. In Northern Virginia, that's not very favorable there in terms of I mean, what have you seen like yourself there? It's not easy to find like a good cap rate.
Yeah, I mean, the prices are just so high that trying to do anything to like a buy and hold to cash flow doesn't, at least working with, being relatively new and not having the systems and resources set up to do a whole lot of off-market stuff. It's very secure and it's growing, and we've got Amazon coming in the next year or two that's going to add, I think, like a couple hundred thousand jobs. So not concerned at all about growth there, but just the prices are to rent ratios are really, really high.
Okay, that's good. Thanks for sharing. Then we have Charles is saying that you have multifamily investments in Florida, Georgia, Ohio, Louisiana, Texas, and Arizona. Like, wow. Do you want to share with us, Charles?
I'm just a passive investor. I'm in a large investing group, and people come up with deals all over the place. So the ones that mathematically work, I'm somewhat interested in. Most of them have turned out rather nicely. So we had one in Edmond, Oklahoma. Oklahoma is not my friend. We had a couple in Albuquerque. That's also not my friend, but most of the others are doing just fine. Well, no, I'm going to say that San Antonio is not my friend either, but the rest of them seem to be doing pretty good.
Okay. Well, so let's say what cap rates are you seeing in Florida and Georgia versus the others? Let's say.
Well, we have one property in Florida. We bought it about 3 years ago, and I couldn't tell you what the cap rate is today, but it's a 120, maybe it's 100 even, but it runs at about 99% to 100% occupancy. I wanted to push it to 110. We can make more money that way, but it does just fine. It's a little moneymaker, so we like that one. But as for the cap rate there at this instant, I couldn't tell you. And we're not planning on selling anytime soon. They're not even looking at it because it makes money.
Where have you seen the most appreciation? Like your
yeah, it's gone up.
Your skin kind
of. It's in Hilliard, which is outside Jacksonville. So it's a little country place, but we don't have much competition. And we stay full all the time, and we keep pushing the rents up, and they keep paying them, so we like it.
I see. And then the rent appreciate, like raising rents.
Oh yeah, we've gone up. We're going up. Let's see, in percentages, 20. I think we went up like 20% in the last 2 years, so maybe 10% a year. But it's we can't run people off. We can't get any vacancies in the place on a long-term basis. So we keep raising them.
You have like 10% rent increase a year you have had.
Well, yeah, let's see. We were at maybe it's 8%, but anyway, it's higher than we believe we could get away with. So, but they keep staying full.
And during COVID now, let's say in 2020.
That one, we in the COVID period, we had one fella, and he and his wife got a divorce or something, and so he decided to pay his attorney rather than us. He's gone, and we have, and they didn't happen at the same time. So we've only had one resident at a time who's had a COVID problem. So we've got one right now, and we're discussing with them how to get away with it. And then we have one sheriff employee, and she pays late every month, but she pays every month. So we're sort of used to her, and we've got it worked out with her. But that's pretty much the worst case on the deal. But it's it's managed by a third party. I'm just an investor in the thing. I keep tabs on the deals pretty well. But that's pretty much where we're at on that one. Let's see, in order, the Georgia one's in Athens, where the University of Georgia is. It's not that close to the campus, but it's about a 250 to 300 unit apartment. It's doing pretty good. I mean, COVID has been a problem everywhere. Nothing's great. Ohio, we got 2 in Columbus, 1 in south of Cleveland. It's Euclid. Is that the right word? It's South Cleveland. But it's right next to an Amazon place. Somebody else mentioned that, so that's what it is. The Louisiana property, I wish it were doing better. It's a long-term value play, so it's not paying anything at this point, but we're fixing it up. COVID has slowed that process down, which is a pain in the, anyway, but let's see,
You
Texas.
do like passive investing in other people's syndications. Is that what you?
I'm lazy.
Or?
I'm lazy. I'm retired. I had a job I didn't mind and I liked it, so I never went into the syndication part of it or the deal sponsor part. I just
do
it as a passive.
Bet sponsors. Do you know them well, or like what do you?
Yeah, we're in a large group. I pretty much everybody I've invested with is in that group or was in that group. So I've shaken the hand of everybody I've invested with. Had lunch with them on multiple occasions. Met them, many times. They're all trained pretty much by the same guy, so I know how they work and what they're supposed to do. And is it perfect? No, we've had a few that have not worked out well, but most of them do.
Right. Cool. So yeah, you can look at Amy's project maybe in Texas.
Well, my wife and I and my 2 kids are in an LLC together, and my wife does not like Houston because they have these things called hurricanes. She won't go anywhere near Houston, so she keeps telling me no Houston.
Okay.
Now, there's been several good deals down there, but she won't let me do it, so I don't do it there. We're in Abilene, we're in San Antonio. Don't like San Antonio that much. We're let's see, in Longview, Tyler, and Greenville, along with several in the Dallas-Fort Worth area.
Okay, cool.
So she doesn't like hurricanes, but she likes tornadoes. So that's good.
Well, you may have a point. Does Houston not get tornadoes? I really don't know.
No, it's not in Tornado Alley, but Abilene it sure is, and so is Oklahoma.
She's from Oklahoma, so she doesn't know any better.
And I wanted to ask you, Charles, what group are you in?
It's Some Rocks.
Oh, you're in Brad's? Okay.
Yeah.
I've known Brad since 2008. So I'm not in this group, but I've known Brad.
Yeah.
Very cool. Yeah.
He's pretty reasonable most of the time.
Okay. Yeah.
Nobody's perfect, but he's pretty good.
Yeah.
All right. Thanks for sharing. That's cool. And
No
actually, my friend Rosen is asking, is there an option for investment out of the USA? So Amy, what would you say about that in terms of like 506C versus 506D? Like, how does it work with, are there foreign investors or?
So in 506Cs or any sort of syndication, you can have a foreign investor, but they have to jump through a couple of hurdles before you even get there. So they need to know what it takes to invest. Because normally when you go on a raise, you don't have time for them to figure out their crap, because basically they have to have a U.S. citizen form an LLC in which they become investors into, and then that LLC invests in your deal. So there's a couple of hurdles. Now, when you change your how you raise, like so if you were to go create a fund or do a Reg A Plus or do a REIT, or it changes kind of what foreign investors can do. But if you're looking to invest outside of the United States, I've looked at it. I have a friend who lives in Hong Kong. He's a U.S. citizen, but he lives in Hong Kong, and Hong Kong real estate is fabulous. I mean, it's crazy. And there's other favorable markets outside of the U.S. that aren't going to penalize you like crazy. Like Germany will penalize you like crazy if you come and try to buy their real estate. But and Singapore has some weird hinky things, but Sweden is very friendly to foreign investors. Australia is very friendly to foreign investors, and those markets tend to be fairly good. So that's just kind of my half a nickel on that.
Okay, but in terms of a foreigner investing in the US, the main sort of challenge is that he has to be quick enough to set up his LLC And
They
that's-
got to know what they're doing before they even come find you. So they've got to set up they've got to get their corporation set up in the US and get their money ready, and then they can go in and find deals. So yeah.
Makes sense. Okay. Sounds good. Okay, so yeah, we're a bit over time, so we'll try to like wrap it a bit quicker. So we have, so let's say the question like, is North Carolina good for investments like Charlotte or Raleigh? Yeah, I bet it is, broadly speaking. I mean, not cap rates, but appreciation, etc. I think that's the general consensus there, that they are good markets. Another question. So I've heard that Northern New York is seeing a decreasing population even prior to COVID. I'm curious if that's the case. And so has COVID decreased it or accelerated it? I mean, I don't think anyone has like too much population statistics now. Like I mean, there would be a little bit, but not too good population statistics, mainly estimates. For the last year, I mean, there will be the population count. I mean, there's a population count that was done, but yeah, so hard to comment like how much is changing now, but definitely it has nothing to do with COVID. There's New York State has, as you commented, has been decreasing for over, for 10 years and more, maybe 20 years, etc. And then, so definitely there is, if you look at the cities in New York State, well, except around Niagara, as we commented, around Niagara and Buffalo, that seems to have seen an increase, but most of the cities in upstate New York, they have seen a lot of decline. They have had like declining population, etc. And then another question, tokenization solves the liquidity problem? Yeah, sure. I mean, if they overcome all the legal hurdles in US for tokenizing real estate, then then that's gonna make it liquid, and then people like me who want like half of the tax market value are not gonna find this deal anymore. It's gonna be more liquid, but maybe you'll find more deals at some level of illiquidity initially. And then you'll be able to buy, like at the beginning of tokenization, probably would be a great opportunity to buy sort of liquidly a lot of stuff that has some kind of price discrepancy. And then, gradually it's going to be disappearing. But from what I know, at least I have a friend who has a real estate tokenization company in New York City. And from what I think the way it's set up, I think it's a little bit of a gimmick, or I don't even know the details, but I think it's kind of you set up a special purpose vehicle and sort of do stuff there. I don't think it's like very genuine. There isn't too much value of the tokenization itself, so to say. Like, I believe, I'm not like a super huge expert, but it seems to be not happening much in US. It's done a little bit under this SPV stuff. That's like pretty much what businesses are doing, but it doesn't seem to be progressing too far. So I wouldn't think it's going to happen too quickly. Okay, and then Dallas, so Dallas, Texas, I don't know, like every market in Texas is pretty much booming, and Dallas and Austin are overvalued in my opinion. So let me check quickly actually what I have. So Dallas, Texas. Yeah, Dallas, Texas is actually not too bad. Dallas, Texas like only 6% overvalued. It's looking pretty good, I would say. And then Austin, Texas, yes, that's overvalued. Austin, Texas, 15%. It's only like 6%, at least that's what I have, 6% overvalued Dallas, 15% overvalued Austin, Texas. Yeah, Austin, Texas is among the kind of the most overvalued cities. So in this sense, but still, I mean, it's gonna do really well. 15% is not terrible. It's gonna do, I'm sure, really well until then it doesn't. So that, and purchased 2 units in October. I got 10% of list price, 2 great areas, I think. So that, let me see who is that. So that's for Dallas. Okay, so for Dallas, so 10% of list price off the list price, so 10% discount, I assume. Yeah, actually, it looks like Dallas is looking pretty good. I mean, I'm guessing maybe the appreciation has been a little bit less strong than the other Texas markets. So I think it's, what is it? So it has appreciated. It's still amazing. It's like 63% above its previous fair value. Like great. Okay, like in 2010, 2011. Yeah, it's like, I don't know. I don't think you can go wrong in Texas pretty much anywhere. So it's still great. Yeah, 63%. It's only 6% overvalued. So I think that's looking great. And then, yeah, so that, yeah, then Konstantin shared like some of his stuff on for WhoopNet. Okay, all right. Okay, yeah, so I think that was all, and we're pretty much over time, so I don't wanna go like tire everybody even more. So if you guys have further questions, let me know. I don't know, that's just, I wanted to like see everyone's opinion, like have, you know, our experts here today. I was very happy for that. And just like curious to see like where people are investing and like how, I don't know, just how that compares to my understanding, I guess. So that was good. Thanks everyone.
Thanks all.
Really appreciate it. Yep.
Thank you.
Thank you, Stefan.
Thank you. Thanks a lot. Yeah, so just finishing up here. So this recording is going to be on YouTube. So Finance Meets Real Estate on YouTube. So if you want to see like previous recordings, please check that. So I upload everything there. Thank you so much. Really appreciate it. Thanks to everyone. Bye.
Thanks. Bye.